318 trillion. That's how much debt exists in the world right now. Not some projection for the future, not a worst-case scenario. That's the actual number confirmed by the Institute of International Finance at the end of 2024. Now, here's the part that should make your stomach drop. The entire world economy, everything we produce in a year, is only worth about $105 trillion. We owe 3 times more than we make. And while all this is happening, silver is sitting at $6,400 an ounce. You want to know why that matters? Because we've seen this movie before. Not once, not twice. We've watched this exact sequence play out across every major civilization in human history. And right now, we're in Act 3 of a 4-act play that always ends the same way. Let me show you the pattern. It's simple, almost too simple. That's what makes it so dangerous, because most people refuse to believe something this straightforward could bring down the entire system. Act 1. A country starts with real money. Gold coins, silver coins, something you can hold, something that has actual value. This creates trust. Trade flourishes. The economy grows. People believe in the currency because it represents something real. Act 2. The government needs more money. Maybe there's a war. Maybe there are expensive social programs. Maybe the leadership just wants to stay in power, so they start cheating. They make coins with less gold in them. They print more paper than they have metal to back it up. They tell everyone the money is still good because the government says so. And for a while, people believe it. The money supply explodes while the real wealth behind it stays the same. Act 3. Prices start climbing. The currency weakens. People notice. They start trading their paper for anything real. Land, commodities, gold, silver. The government panics and prints even more money to cover their obligations. This makes everything worse. Prices spiral out of control. Trust collapses. Society starts to fracture. Act 4. The currency dies. Sometimes it's quick. Sometimes it takes decades. But it always dies. The government either introduces a completely new currency or they're forced back to commodity money. There's an economic reset. Often there's civil unrest. Sometimes the entire regime falls. And here's what matters for you. The people who saw it coming and bought real assets, they survive. The people who trusted the paper, they lose everything. Now, let me prove this isn't theory. Let me show you 3 times this pattern executed with mechanical precision. Starting with Rome, 64 AD. Emperor Nero has a problem. The Great Fire of Rome just destroyed 2/3 of the city. He's fighting wars against Partha. There are civil conflicts bleeding money. The Jewish revolt is draining resources. And Rome's silver mines can't keep up with what he needs to spend. So Nero makes a decision. The denarius, Rome's silver coin, had been about 95% pure silver since Augustus ruled. Nero cuts it to 80%. Same coin, less silver, more coins from the same metal. Problem solved, except he just set a precedent that would destroy Rome. Fast forward to 197 AD. Emperor Septimius Seius wants to keep his soldiers loyal, so he doubles their pay, but he can't afford it. The denarius drops to 46% silver. His son Caracalla takes it further. In 215 AD, he introduces a new coin supposedly worth 2 denarii, but it only has 1, 5 times the silver. By the time Gallienus is emperor in the 260s, the silver content has collapsed to 5%. What was once a silver coin is now a bronze piece with silver paint. What happens next? The price of grain triples. Soldiers refuse to accept the coins. They demand payment in goods. The economy partially collapses. People hoard the old coins with real silver in them. Bad money drives good money out of circulation. By 310 AD, Constantine has to create an entirely new currency just to restore some kind of order. The old denarius worthless. You need millions of them to equal 1 new gold coin. That's the pattern. All 4 acts, and Rome was the dominant superpower of its time, just like America is today. Let's jump ahead to Weimar Germany 1914 to 1923. Germany abandons the gold standard when World War I starts. They're certain the war will be short and the losers will pay for everything. Germany loses. The Treaty of Versailles hits them with 132 billion gold marks in reparations. In today's money, that's over $500 billion. Annual payments eat up 5% of their entire GDP. The new democratic government wants to keep voters happy. They want to rebuild. They want social programs. Tax revenue only covers 37% of what they're spending. So the Reichsbank starts printing. Before 1914, Germany had a gold-backed mark, one of the strongest currencies in Europe. Solid foundation. Then they start printing to pay for everything. In early 1922, it takes 160 marks to buy $1. Bad, but manageable. By December 1922, 7,400 marks per dollar. That's a 46-fold devaluation in 6 months. Then 1923 hits. France and Belgium invade the rarer to take resources as payment. The German government supports a general strike, paying 2 million workers to not work. The printing press goes into overdrive. June 1923, 192,000 marks per dollar. October, 170 billion marks per dollar. November 4th, 2 trillion marks per dollar. People are carrying wheelbarrows of cash to buy bread. A student orders coffee, and before he can order a second cup, the price is increased by 40%. Workers get paid twice a day because their morning wages become worthless by afternoon. Farmers stop selling food for paper. People are starving. The middle class is annihilated. Within a decade, the trauma and desperation from this collapse helps bring Hitler to power. November 15th, 1923. The government introduces the rent mark. 1 trillion old marks equals 1 new rent mark. The old currency is declared worthless overnight. Everything resets. Same pattern. All 4 acts, a country with arguably the best engineers and scientists in the world at the time, couldn't stop it. Now, the United States, August 15, 1971, President Nixon goes on television and closes the gold window. Foreign governments can no longer exchange dollars for gold. The dollar had been backed by gold at $35 per ounce since the end of World War II. Nixon says this is temporary, says it will stabilize the dollar. It's never reopened. Before Nixon, from 1944 to 1971, the dollar was backed by gold. Other currencies were pegged to the dollar. This created the post-war boom: stable international trade, monetary order, real foundation. But by 1971, there are 4 times as many dollars in circulation as there is gold to back them. The Federal Reserve has been printing to fund Vietnam, the Great Society programs, expanding government commitments. After Nixon closes the gold window, all constraints disappear. The 1970s, stagflation, oil shocks. The dollar collapses against real assets. Gold goes from $35 per ounce in 1970 to $850 by 1980. 24 times higher. That's not gold going up. That's the dollar being exposed for what it is. But the printing never stops. To date, financial crisis print trillions. 2020 COVID response print $6 trillion in 18 months. Today, U.S. national debt is at $1 trillion. We're paying $892 billion per year just in interest on that debt. That's more than we spend on defense. And by 2034, interest payments are projected to hit $17 trillion annually. Here's what's happening right now. Before 1971, when productivity went up, wages went up. Since 1971, productivity keeps rising, but real wages flatline. The wealth gap explodes. Asset prices inflate while your purchasing power erodes. In 1971, someone making a median income could save up and buy a house in 5 years. Today, over 7 years, food costs more, energy costs more, healthcare costs more. The middle class is getting squeezed from every direction, and globally, trust in the dollar is cracking. Central banks are diversifying their reserves. BRICS nations are openly discussing alternatives to the dollar. China and Russia are accumulating gold at record rates. We're in late Act 3 right now. The crisis is building. So, Where does silver fit into this? Throughout every currency collapse in history, people flee to real assets. Gold and silver have been money for 5,000 years, not because of tradition, because they can't be printed. They can't be debased. They can't be created by government decree. Gold is currently around $4,200 per ounce. Silver is at $64. That's a ratio of about 67 to 1. Historically, that ratio averages between 15 to 1 and 50 to 1. During currency crises, it tightens dramatically. If the ratio just went back to the historical average of 50 to 1 with gold where it is now, silver would be trading at $80 per ounce. That's a 34% increase from current prices just to hit the average. But here's what the pattern tells us. In Rome, as the currency collapsed, citizens hoarded silver coins. In Weimar, as paper became worthless, people traded for tangible goods. In every currency crisis throughout history, precious metals become the refuge. Silver, which serves both as an industrial metal and monetary metal, is trading near multi-year highs, while we have $318 trillion in global debt. While central banks are printing without limit, while the pattern is executing in real time, the inflation-adjusted high for silver from 1980 would put it at $194 in today's dollars. The 2011 high adjusts to $70 today. We're trading at $64. The metal that has been money for millennia is priced as if nothing is wrong, as if this debt can somehow be managed, as if this time is different, and that's what they always say, this time is different. American exceptionalism, the dollar's reserve currency status, modern monetary theory, technological innovation, strong institutions. They said similar things in Rome when it ruled the known world. They said it in Weimar Germany, one of the most advanced societies of its time. The pattern doesn't care. You cannot sustain $318 trillion in debt against $105 trillion in economic output. You cannot debase a currency indefinitely. You cannot print your way to prosperity. These aren't opinions. These are mathematical realities. The laws of economics work like the laws of physics. You can ignore them. You can deny them, but you cannot break them. And when they reassert themselves, it happens fast and without mercy. Silver isn't an investment. It's insurance. It's a hedge against the mathematical certainty that this debt structure cannot continue. It's a bet that history doesn't stop being history because we have iPhones and artificial intelligence at $64 per ounce. With the gold-silver ratio at 67 to 1, with debt at all-time highs, with money printing continuing with interest rates trapped, because raising them would collapse the debt structure. The risk-reward equation is staggering. The pattern is executed for 3,000 years. It worked in Rome. It worked in Weimar. It worked after Nixon. The machine doesn't care what you believe. It only executes. And right now, it's executing. Buy silver, not because you think the world is ending. Buy it because you understand patterns. Buy it because $318 trillion in debt demands a resolution. And every historical example we have shows that resolution involves the repricing of real assets against failing currencies. Buy it because the people who hold real assets when Act 4 arrives are the ones who survive. The machine is running. The question is whether you'll be ready when Act 4 begins. If you want to understand exactly how this machine was built, who engineered this system, and what specific moves you need to make to protect yourself when Act 4 hits, subscribe right now. The next video breaks down the mechanics of currency creation, why central banks have been accumulating massive gold reserves while telling you inflation is under control, and the 3 assets that have survived every single currency collapse in recorded history. This isn't conspiracy theory. This is pattern recognition, and the pattern is screaming at you right